Hey everyone, this is Andy from the Finding Value Finance channel. I've got Scott with me, Sow and Reap Capital. He's got the bomber jacket out. He's in winter over there in Australia. So thanks for coming on, Scott. Really appreciate it. I've got some really good questions that I brought up. I don't have answers for it. I don't know if anyone does. The question that's I keep pondering it, keeps in my head is, with this energy crisis that's coming up, is it going to change the world as we know it today? Like, we've got what we know in the past. Surplus energy, it's cheap. We could sit on our butts here, go on our computer and order from Amazon and stuff shows up at the front door. Pretty easy. Things are, they're hardly ever out of stock. We're running into more problems as time progresses. We have an energy crisis. We're seeing it in Europe. It's transferring and making its way to other countries all around the world. Things are becoming a lot more short in terms of buying things and that we can't get it. It seems to be getting worse, not better. So the question is, are things going to get materially worse with the energy crisis, with all of these commodities and making these products and all these shortages? What's your opinion there, Scott? Where is, the investment for the next 5 to 10 years? What do you think will be the next great investments? And what do you think that, we'll call it, society is going to look like? Are we going to see continued shortages? Are we going to see what is that world going to look like, in your opinion?
I think there are probably two main things. I think you've talked about the energy crisis. I think there's going to be a continued energy shortage, unless like something dramatic happens between Ukraine and Russia, and Russia starts producing natural gas to the European countries. I think the European countries are under a tremendous energy pressure, right? So I think that will continue most likely. I just don't see how. I don't think there's an incentive for Russia to be producing commodities for other countries right now, because I think their economy, because they've got so much natural resources, I think they can really internalize their economy. And your bigger nations right now, like Russia and China, is in the process of getting rid of fiat currencies, right? So they want to swap them for commodities, and that's been a trend. Like whether it be buying gold or stockpiling their commodities, that's been the trend for Russia and China, right? So I don't see how that's going to change, because there's just no incentive. It's like, I'll give you what doesn't make sense for them is, like, they are giving like Western countries, for example, real stuff for fiat currencies right now. And I just don't think it's a trend that will change, right? And so I think that will continue. I think another thing is food shortages. I think food shortages is going to be real, because, as you know, like fertilizers are, byproduct largely of oil. And I just don't think, I mean, fertilizer, I think Russia produces 20% of world's supply of fertilizers. And that Russia, for example, has been, and obviously Ukraine and Russia together, I think they produce quite a lot of wheat as well. I think maybe 30% or something like that of global supply. And that Ukraine, because of Russian attack, they haven't been planting, they haven't been farming, basically, because Russians have destroyed their farming land, for example, and have taken over it. And they've been like stealing their essential supply as well. So I think food supply, well, the lack of farming activities this year, for example, in Ukraine and Russia, will lead to significant shortages of food in the coming months, and maybe over the next 6 to 12 months. And I think there's going to be a massive shortage. Like, I mean, I think it's also a global phenomenon, because now the Western countries don't have the fertilizers necessary. So what could benefit from this? I think energy companies, for sure. So I know your favorite is natural gas. I think natural gas is bound to benefit, unless there's something dramatic that happens between Russia, and Russia suddenly decides that they want to supply all the natural gas to Germany, for example, because I think like 58% of Germany's natural gas supply comes from Russia, for example. So they very much rely on Russia's supply. And that's why we're seeing the baseload power cost in Germany just skyrocket, right? Because I think it's gone up like 20-fold, something like that. So I think that's going to continue. So natural gas is probably going to benefit, as you say, Andy. And I think also uranium, because you're seeing now Germany, I think they just announced that they're going to be keeping the nuclear power. I think that 3 nuclear reactors on, or something like that, was announced yesterday. I think that's going to be a huge trend as well. And I think China is really going to hurry up and start really build their nuclear reactors really quickly, maybe quicker than most people anticipate, because I mean, this is real for everyone, really. If you're talking about energy crisis, this is real for everyone. So I think there will be a huge scramble. I think a lot of the people, a lot of these utilities companies, for example, and a lot of the manufacturers will try and manage the risk by stockpiling in advance. I mean, literally, this is like risk management 101, but they will try and stockpile it because they know that there's a supply chain issue, that they know that the scarcity of commodities and that the prices are going up. To try and manage their risk, I think they will try and stockpile a lot of the commodities. And whoever stockpiles first will probably be the winners, because if you're going in late to stockpile, then you're going to be paying a lot higher prices without, I guess, the security of supply, right? So I think we're just looking at a whole different world now, because like it's not just energy, it's not just food, but it's like everything, all the commodities basically. And obviously energy is a huge input cost into producing all those commodities, mining out all those commodities. And also it's a huge input cost into manufacturing whatever your final product might be. So it's going to be a different world, I think.
Well, so here's my thing that I stumble on all the time. Money's going to rotate where you can make money. So I'm going to ask something that's going to be a little bit different here. If energy is the thing that's constrained, and energy costs go up dramatically, how are regular companies that consume energy and commodities, which commodity prices will go up, because if your energy price goes up, the commodity goes up, then also the final product goes up, that of the companies that convert commodities to usable products. How are they going to make more money if more money is transitioning towards energy to solve our energy problem? There's going to be a lot less money for them, and it's going to be at much lower margins. So if money's going to flow to where money's going to be made, and I'm just kind of projecting forward, in this new world, in an energy crisis, money's going to be diverted away from bonds, away from stocks that are converting commodities to usable products, because they're going to be ultra scarce. If those companies use copious amounts of energy in converting those commodities to usable products, they could go bankrupt if they don't hedge themselves, or if they don't do certain things correct. What I'm describing is a world that they've never had to prepare for, ever. So if they've never experienced this type of environment, what's the likelihood of these companies actually being successful in navigating through this environment unscathed? And, I'm just kind of thinking of it that way. So there's a ton of risk over in the actual companies. Bonds, I think, are going to get absolutely decimated. So all the money's going to leave there. What actual companies and industries are left where the money could actually flow and make money? I'm not even convinced that mining companies would do that well in the scenario that I'm describing. And here's kind of just a huge curveball is, I mean, what if everybody just goes to war for resources? What if this is it? And how do we know that this is it? And I'm gonna show you one quick thing here that I was looking at, and I don't know if you've seen it yet, Scott. Maybe you have. I'll share it here in any second. I have it on Twitter here. Let me pull it up real quick on my profile. And this is the oil supply outlook. And this is what's projected. First, I'll tell you where it's from. It's from Aramco. So this is Aramco. 30 million barrels of oil per day supply gap in the next 8 years. And if you look at this, we're living here where there's, not much of a supply gap. We've been using the strategic petroleum reserves. We've been milking this thing as far as we can. When those inventories are done, I don't know what that forward thing looks like. But if this is a 30 million barrel gap here between the red line and the top line here in 2030, which is only 8 years out, I'm trying to think like, who's going to make this? Like if there's that big of a gap, we're talking like 3 million barrel gap is going to be like a moonshot. 30 million barrel gap, and I'm sure it won't be that big, but let's say it's 20 million or 10 million, and that's 3 Saudi Aramcos more that we need in the world, and I don't think it's there. What does that mean for these companies? I mean, are we gonna, anything that's a company that is poorly run or is in debt, needing to survive based off of low interest rate loans, they're going to get flattened. They will cease to exist. What about complicated supply chains? They have to decomplicate themselves. They have to basically unwind all of this just in time that everyone's learned in their MBA programs. So, do you think that the world is even sustainable with a gap anywhere near that? Like, what do you think could happen? I don't know. Maybe I'm over the top, but a 30 million barrel or 20 million barrel or 10 million barrel gap, what do you think that's going to do to these companies? You think they're just going to get wiped out? Like, what's going to happen?
You mean the manufacturers and the producers?
Well,
They could get wiped. I mean,
yeah.
I think as you said, I think certain sectors will go through demand destruction, right? Because I mean, everyone likes to talk about demand destruction, but I really do believe, like consumer discretionary, for example, they might go through demand destruction as people allocate more money to essential goods and services, right? Like energy, like food. And I think that's where money will go eventually, because I mean, you're seeing signs of it right now with uranium, for example, with the Biden administration supporting nuclear power, giving them credits and things like that. So ESG credits, or giving the enrichment companies, $700 million. So you're seeing signs of it now. And I think as we see problems arise in other sectors of energy, right? So like natural gas or oil or whatever it might be, I think governments will start throwing money at it as well. And I think as they start throwing money at it, it's going to drive energy prices even higher. But what it's going to also do is also attract investment demand into those sectors, because people know, like smart institutional money know that when governments throw money at it, the price of the thing that they're throwing money at has to rise, right? So I think institutional money will start chasing it. I think the retail money will also start chasing it. I think this is exactly what happened if you look at very high inflationary times in other countries, like Weimar Republic, for example, where stock prices do have to rise because people have to get out of the fiat currency. And this is just a start of the fiscal policy, because we've talked about this before, Andy, where as soon as, China, countries like China, for example, go through recessionary fears, they are going to stimulate the economy through their fiscal policy. They are going to start a stimulus program where they, build infrastructures just like we've seen in 2000s, right? That's why iron ore prices, for example, in 2000 just skyrocketed, and all the iron ore companies skyrocketed. So I think we're going to see signs of that. So right now, unlike the 2000s, the problem is in energy, and I think governments around the world are starting to recognize that there's an energy security issue. I think they're going to start throwing money at it really, really hard. Whether it be the utilities companies or the grids, where the oil and gas producers, or uranium. Because right now, if you look at the past decade, because of ESG and because of the decarbonization initiatives, they really try to move money away from oil and gas. I think at some stage that might flip. Because everyone was so focused on oil and gas and decarbonization, but now wait until they start freezing, right? The people of the nation start, freezing, start experiencing really cold weathers, for example. Like the whole sentiment could flip in a heartbeat. So rather than drawing money away from those industries, maybe they will pour money into those industries. And I think for me, the reason why I like uranium so much is that you don't have that risk in terms of decarbonization. It is ESG friendly. It is probably one of the cheapest and most reliable sources of energy. And I think, yeah, money's going to pour into the nuclear sector as well. I think Bill Gates also just raised their, I think it was like 700 and something billion dollars for their TerraPower as well. So he's obviously a huge promoter of nuclear energy. I think nuclear energy, I know in the 1970s, I think something like that, they said it was like the new paradigm because it could literally like give you unlimited supply of energy, right? Because like it is, uranium isn't really rare in the sense that you've got a lot of uranium underground. We just haven't mined it. We just haven't explored it. We just haven't mined it out. So I think there will be a huge movement into nuclear power. And I think a lot of the uranium companies, as well as the enrichment companies, will probably benefit out of it as well.
Now, if we were in this like big energy crisis, do you think that we could simultaneously go into a gigantic mining boom when we're in a deep energy crisis? Do you think that's possible?
Yes, I think so.
You think it's
That's
possible?
kind of how I see it. That's kind of how I see it, because I think the money has to find itself somewhere, right? Because there's got to be sectors that benefit in these type of environments as well. Like within the 1970s, for example, I mean, there was somewhat an energy crisis back then, and we saw the miners absolutely boom, right? So the energy companies absolutely boomed during that time. So I think there will be sectors that benefit from this, and I think it's really just the flow of money. Like if you think about the tech companies through your retirement accounts, for example, most people are investing in the tech sector right now. If you think about it, right? So you're talking about literally 90, let's say 90 people out of 100 have invested in tech sector. You're talking about all the 90 people who don't have any exposure to energy right now, pulling out their money from tech sector into energy sector, because they can't just hold cash. Like in this environment, in this inflationary environment, they can't just be holding on to cash. And so as governments start diverting money into solving this energy crisis, right, that will initially introduce money flow into the sector. You will have institutional money that will try and follow the government or front run the government, that will drive prices higher. And then retail, when they see the energy sector skyrocket, and when they see energy bills skyrocket, they will try and look for a hedge. And they will be, okay, I need to invest in energy. And so I think all that money that's been held in bonds and general equities right now will have to flow into a sector, because they can't just go into cash. And I think it will be energy. I think energy will probably benefit the most out of this.
So basically, our only way out in the short term is if Russia turns back on their natural gas. But we would still be very tight on oil, I think, anyway. So we would still have the energy crisis. It may not just be as bad, and it would be definitely muted a little bit in terms of natural gas. Man, so another question that I have is, are there things in this world that would become ultra valuable you could purchase it now today in a low energy cost environment, and then in the future it would be ultra valuable to own those things because the energy costs have shifted to a much higher level? What do you think some of those things would be? You think it'd be like physical precious metals because of the high energy content? Is it like doing a remodel on your house with a bunch of cement because the cement is high energy input costs? Or what would a person do to prepare for a decade of, like, we'll call it much higher energy prices? Like, what do you think would be, outside of like the obvious direct plays of energy? Like, is there something else? Are countries going to ship things, not across the world? Are we going to kind of like, would shipping slow down, speed up? Like what do you think that would, I don't know. I'm just kind of seeing what's your thoughts?
So precious metals, definitely, I think they've always performed very well in a highly inflationary environment. So I do like precious metals. And because it's a safe, rather than holding cash, I just like holding precious metals, right?
Hmm.
For me, it just makes sense because I don't want to be holding onto fiat currency, which will, most definitely lose purchasing power over time. Like given a long enough period, you're always going to have devaluation of fiat currency. So to stay away from fiat currency and to invest in precious metals makes sense for me. And they performed really well during the 1970s, for example, right? Gold went, silver went from something like $5 to $50 in like a period of couple of years. So you could have a period where precious metals do go through a massive boom. And the reason for that, I think, is because as you've seen in the recent times, China and eventually or the rest of the world will have to follow what Russia and China are doing in terms of getting rid of their US treasuries. What are they going to convert into, right? Because they've got to convert US Treasury is this form of their reserve and it's form of their asset that they can store for a long period of time. But if you don't have US Treasuries to invest in, or if you don't want to be investing in any sovereign funds or sovereign bonds, then the only real alternative for those countries, I believe, are probably precious metals. They can buy other commodities as well, but something that you can hold on for like indefinite period of time, I can only think of precious metals. So I think it will be the sovereign funds that really goes into precious metals and starts investing in them. And once again, that will probably draw institutional investors and retail investors' attention. Shipping is a very interesting one. I do like shipping a lot right now. And the reason why I say that is because I think a lot of the manufacturers the initial steps I think the most manufacturers and producers will take to manage their risk is because it's hard for them to build immediate, I guess, manufacturing facilities, for example. The best way they can manage the supply chain risk, the scarcity of commodity risk, for example, is to stockpile. And I think there will be in the short to medium term a lot of stockpiling. So before all the deglobalization happens, right, I think they will need to try and stockpile as much commodities as possible. So I think from that perspective, it will probably temporarily in the short to medium term increase shipping activities. That's kind of how I feel, because I think deglobalization is a longer process. If you think about uranium, for example, just simple thing as uranium or anything, first of all you need to have the resources in your country, right? So if you're talking about iron ore, which is okay, well, let's talk about iron ore because iron ore is probably the heaviest contributor to BDI, so the Baltic Dry Index. So if you talk about iron ore, for example, you first need to be in a country where you have iron ore underground, like Australia, like Brazil, and then you need to explore it. You need to get permitting and licensing for it. You need to dig it out of the ground, and then you need to try and source it for your country. I mean, right now, if you haven't already got a mine that you've explored in the recent times, the process, the time it takes for you to start exploring and start making mining out that resource will take years and years. What I'm trying to say is for deglobalization to happen and for the shipping activities to absolutely stop, I believe you need many years for that to happen. And as you know, like, I mean, we're just not building enough ships. So I think shipping can be a very attractive sector right now.
So here's should we call this the great reconfiguration? Because the economy is going to have to reconfigure itself into something completely different than what it is today. Would you say that's a fair statement, that everything has to reconfigure and jobs have to change dramatically?
Yes, I think so. I think it will change dramatically. As you said, like just-in-time methods, for example, for your manufacturing, it's probably not going to work. And yeah, I think you will seriously need to retrain your staff. So another part of the transition to deglobalization is that you need to find staff. Like I mean, if you haven't got the workforce in the country to say for example, mine out iron ore, like that takes time as well. So it takes time to find the talent from maybe overseas, bring them in, train your local people, and actually mine it out. That all takes time. So deglobalization can't happen overnight. It's going to take years and years and years. And before that happens, I think, as I said, as the countries around the world, as the sovereign funds around the world try and source commodities and try and stockpile commodities that exists right now, I think that will temporarily increase shipping activities, and therefore the rates.
And here's another thing that I've always stumbled on. During this, I'll call it the Great Reconfiguration. I'm gonna trademark that myself, I guess. We'll name that the video too, the Great Reconfiguration. Here's another question though. If you think there's going to be a great rotation out of bonds because of energy prices, do you think interest rates, I mean, they're going to have to buy everything out there, right, to hold interest rates down to a somewhat okay level.
Yep.
So, I mean, is that going to be highly inflationary if they're just going to be creating money and literally buying all these treasury bonds? I mean, wouldn't that be highly inflationary because they're going to create money?
It will be very highly
Someone's
inflationary.
going to say, I'm going to get rid of all my debt and then, or all the treasury bond debt, and then they're going to get cash in return from a buyer that has to buy it. That
Yep.
is inflationary. So, I mean, could we have less lending in the system, but still have all of this reconfiguration of the market where money still flows into energy and all this stuff, and then we still have high inflation rates, even though historically inflation came from lending? Is that possible?
Oh, 100%. I think that's exactly
Yep.
what's going to happen. So I think, I mean, we're seeing signs of it now in that Fed can't really cut their balance sheet, right? Because I mean, traditionally, if you think about the old world, it was the sovereign funds, right, that bought US Treasury bonds, right? They were the biggest buyers in the room. So Japan, China, for example, they were the biggest bond buyers in the world. Whereas now, in the recent times, the Fed has become the biggest buyer in the room. So as soon as you take away the biggest buyer in the room, what happens immediately is bond prices tank and interest rates shoots up. But Fed knows that they need to control the interest rates to some extent, right? Because they can't let the interest rates rise to 20%, for example, in this economy. Not because, I don't think, of the private debt, it is more because of the public debt. And if you think about the mortgage-backed securities, they are ultimately backed by the government. From Fannie Mae, Freddie Mac, all that, they are ultimately backed by the government. So essentially, they're not really private debt. Ultimately, they are government debt because they are backing it, right? So if you think about the mortgage-backed securities, they got backed by the government. Therefore, ultimately, it's a government debt. If you think about US Treasuries, they're government debt. And unless they change the fiscal policy, unless the politicians change the fiscal policy dramatically so as to cut the spending, the US Treasury spending, and put them into surplus, you're just not, the Fed has no choice. Fed is stuck because they can't just say, oh, we're going to be setting, because this is the myth, right? Because people just think Fed sets the interest rates at whatever they want to, but ultimately it's all determined based on the short-term bond market.
So we think that all of this selling of bonds, nobody wanting bonds, they're going to do QE or some sort of thing, and they're going to buy all these bonds, and it's going to be inflationary. How does this all unwind? Could it unwind? Where, like, how can they get out of this problem? Like, if we get into this energy crisis, it gets too deep. Is it possible that things like do we go to a hyperinflation, or does the debt start to collapse and we go into a deflation? Like, do you think there's a risk of all of this debt having a major problem?
Yes, I think eventually they'll I mean, we're seeing unprecedented level of public debt right now. So I'm not so concerned about the household debt because it's a lot lower than, say, for example, 2000s. But we are seeing unprecedented level of public debt, which means they can't get out of this inflationary spiral. Like, I mean, unless they cut their spending dramatically through their fiscal policy and discipline, they can't reduce the public debt. So I think the most likely scenario is very high inflation. They will try and devalue the amount of debt they have through very high inflation. So that's probably a likely scenario, but that also means that economy is not going to look like it does right now. It's going to be crazy, basically. You're going to see like really high prices. You're going to be seeing social unrest. Yeah, so this could be, I mean, I don't know if you've ever come across like the change of powers theory, where, you know, a nation rises, for example, they're in power for a while, their currency is used as a reserve currency, and then ultimately comes crumbling down because they carry in too much debt. This might be where there might be a change in power. Like, I mean, we could have a currency reset, because I mean, if you look at history, I mean, I think average life of currency is like less than 50 years or something like that. And if you think about the US currency, when did we come off the gold standard? 1972 or something like that?
71.
71. Yeah. So if you think about it, I mean, it's been about 50 years, so it's probably reached its life expectancy, right? So we could have a currency reset, where we reset everything after they inflate the debt away, for example. So yeah, I think we could be in for a wild ride going ahead.
Yeah, because they're going to have inflation, but then the energy crisis is just going to convert all that money right to the CPI.
Yeah, yeah, exactly.
I don't know how they're going to control that. I don't
They
know
just
how
can't.
that's going to work out in the end for them.
It's and you're seeing, like, I mean, it's as stupid as it was to see like history. When we read about history, where we read about governments throwing money at the problem to fight inflationary pressure, like, right? Because, you know, the story I think goes like during one, I forget which inflation story, but basically the story is that with the retirement, with the pension, for example, they say the governments come out and say, oh, the costs are rising, therefore we need to give pensioners more money so that they can go out and buy food. Whereas, I mean, that creates the inflation itself. We read about those stories in the past where we just went, that's so silly, right? But we're doing it right now. If you think about the Inflation Reduction Act, or whatever it's called, whatever the full name is, if you think about that, that's like a $30 billion act. They were gonna be spending that money, right?
Yeah.
So, which is inflationary. So we're starting to see the trends of it now. Like, I mean, and governments are like subsidizing fuel right now, subsidizing energy costs. We're seeing signs of the same thing playing out. So it's very interesting times.
I've got a cool chart here that I want to share real quick.
Yep.
North Star is the one who posted this on his Twitter account, and this is the consumer price index for all urban consumers, all items in the U.S. city average. It's slow inflation, or slow inflation. It started ramping up, and now we're in like vertical mode. So my question is, how do you get out of vertical mode? I don't know if there is a way to get out of it. So basically, the consumer price index measures the overall change in consumer prices based on a representative basket of goods and services over time, just to let you guys know what that is. And it says the takeaway from this graph is inflation is inexorable, however you say that. Basically, you can't stop it. Prices do not return to where they were and are now appear to be in a terminal end phase if it can't be halted. Inexorable. There you go. So I don't know how they're going to turn this around. And you can see over time that it just continues to steepen.
I don't think
So that is where I'm like, oh, man, how do you invest in this type of
inflation genie is out of the bottle. You can't put it back.
Yeah. Is it out of the
I
bottle?
mean, history. Yeah, I think so. I mean, simply put, like, history shows that you can't get out of this inflationary spiral, unless you do something dramatic, like we did back in the 1970s, where we raised interest rate to like 18%. I just don't think you can do it now. Like, I didn't think any politician's willing to do it now. And from the Great Depression, I think the reason why we haven't seen any drops like we've seen in the 1920s and in 1930s following the Great Depression, where stocks literally like just fell through the floor, right? Because we haven't seen that kind of deflationary pressure since then, because I think the politicians and the central bankers have basically learned that that's something that they don't want to repeat again. And at all costs, I don't think that I think they will make sure that there's no deflationary pressure like we've seen in the 1920s ever again. So I think the ultimate route that we're headed towards is definitely very high inflation.
So if that is the case, if it's going to be inflationary, then some of the best investments would be real estate because you can get a loan against a house, a real asset, and then they'll just inflate the debt away.
It could be.
So
It could
so
be.
the question then is, I know we've got a bunch of people that are in the housing bubble camp. This crisis that's coming that we just described is hitting and overwhelming the housing bubble crisis. I know people think, well, how are people going to afford their house with all this inflation? The problem is there's a bunch of guys that have assets where they need to get them out of bonds and put it somewhere. Where does all that money go? And real estate's one of those areas. So I don't know. I mean, I'm not stating that house prices can't fall. Definitely not saying that. I'm just saying, there could be other forces out there that are going to overwhelm the crash scenario. That's all.
Yeah, no, I agree with that. So I think yeah, housing is I mean, in the US, for example, I mean, if you think the housing in the US is expensive, you haven't seen Australian housing yet, or Canadian or New Zealand housing yet.
Right.
And we've talked about in the last show before where in Sydney, for example, over the last year, on average, right, they spent 60% of their total household income on mortgage repayments for new mortgage, for someone who newly took out a mortgage. So, I mean, if you don't think that level of spending on housing is not possible, then just look at Australia, right? Look at Canada, look at New Zealand. So it's more than possible. And I think what happened during the great financial crisis 2008 in Australia was we saw it was still like, I mean, it was considered overvalued back then as well, but we saw a tiny little blip, maybe like 10 to 20% decline in housing, and then it just launched again, like as we came out of that deflationary I guess fear. So I think similar thing could happen to the US housing. Like they you might have a little tiny blip where it falls maybe 10 to 20%, and everyone goes, "Oh, see, the housing is going to crash." But I think the long-term trend is very much intact because, and the reason I say that is if you look at the US housing data, if you look at the mortgage repayment data, for example, it is so low. Like, I mean, as a percentage of disposable income, it's so low when you compare it to the 2000s. Let me try and see if I can pull it out.
Yeah, I agree because I mean, even if we were to get a small pullback here, and we were to get like a deflationary whiff or pressure, I think they would just revert and pull interest rates back low again. So
Yeah.
I don't think they would just keep it high.
Yeah, so this is mortgage debt service payment as a percentage of disposable personal income in the US, obviously. And so here, back in 2007, before the crash, I mean, on average, they were spending 7.2% on mortgage debt service payments as a percentage of disposable personal income. Right now, we're spending 3.9%. So we're spending way less on mortgage repayments now than we did in 2000. So we're not even at that crisis level. This, if you put this together with the unprecedented level of cash that they've got on the sidelines, like I just don't know how, when you've got a combination of low repayments and a lot of cash buffer, I don't know how you see delinquencies in any short order. And that's why I think I mean, for US housing at least, it still looks pretty good. And I think you could be right. I mean, during the 1970s when stock market did nothing, in Australia, housing prices rose a lot. and we saw inflation rate interest rate go up from 6% to 18% as well, and that's just the cash-free risk-free rate. So yeah, you could have a very high interest environment yet have housing prices go up with it, and the low repayments on your mortgages right now is a good indicator that's likely to happen. I think I mean, story is completely different in Australia because you're making, I mean, people are literally, the new home buyers are spending 60% of their total household income on mortgage repayments, and they're going to reach a limit pretty soon, I think. But in the US, it's a different story. It's a different story.
I agree. I agree. So I don't really have anything else. Do you have anything else, Scott, that you want to make a comment on?
No, not really. Not really. I think
You're
that was a
good.
really good discussion. Yeah.
All right. Well, that's what we've got for today, guys. Hopefully you enjoyed the discussion. If you want to follow Scott, that's at @u_ag_ on Twitter, or you can check out some of his videos at Sow and Reap Capital. All right, Scott, thanks for coming on. Really
Sorry, can I
appreciate it.
just quickly
Oh yeah,
share a Bible?
go for it.
So John 3:16, I keep sharing this, but I think this is really the key message out of the Bible. And it says, "For God so loved the world that he gave his one and only Son, Jesus Christ, so that whoever believes in him shall not perish but have eternal life." So basically, it's saying God loves you so much that if you believe in Jesus, he will forgive you and let you into heaven. So that's all I wanted to share.
Good, good. Thank you for sharing. Appreciate it, Scott.
Thank
All right.
you, Andy.
We'll catch everyone next time. Thanks for viewing.